great to see you all here, and thank you for your interest in Aris mining. I'm looking forward to giving you an update on us building Aris mining into the next leading gold mining company in Latin America. Before I dive in, let me quickly draw your attention to the disclaimer, considering that I'll be making a number of forward-looking statements. And now, let's start at a high level. Aris mining at a glance. Aris mining is a Canadian gold mining company listed on the TSX and the NYSE American with a market cap of $2 billion US. All dollar numbers I'm referencing are US. The company has two operating assets in Colombia, Segovia and Marmato, and those two assets produced 211,000 ounces of gold last year, and on an LTM basis generated $264 million of adjusted EBITDA. And we're currently in the process of expanding both of those operating assets organically, such that once both of those projects are at their new run rate levels, we expect to produce more than 500,000 ounces annually from those two assets. And that growth is near term, it's fully funded, and it's permitted. Importantly, beyond those two operating assets that we're expanding to 500,000 ounces, we also have two greenfield projects, Soto Norte in Colombia and Toro Peru in Guyana. And they, as I will update you on, could form the next leg of growth beyond 500,000 ounces as we are looking to double the company yet again. Across our asset portfolio, we have 6.9 million ounces in proven and probable reserves and 19.1 million ounces in measured and indicated resources. And as you will see in a second, this is not just significant in terms of quantum of ounces in the ground, they also happen to be high grade. So when you look at the left-hand side of the slide, you see our two operating assets, Segovia and Marmato. Let's start with Segovia. Segovia is our flagship asset. It produced 188,000 ounces of gold last year and generated an all-in sustaining cost margin of $163 million US. We are right now expanding it. We have delivered the debottlenecking project of the processing plant, which has increased our throughput capacity by 50% from 2,000 tons per day to 3,000 tons per day. And we are now in the process of ramping the mining and the processing plant up gradually over the second half of this year. And we should, by 2026, be consistently running at 3,000 tons per day, which in turn that should then allow a gold production of 300,000 ounces. At Marmato, the story is slightly differently. Currently, we're operating the narrow vein mining zone at Marmato. That's a marginal asset, and that's grounded in geology. So the narrow vein mining zone is an epithermal system that has created a narrow vein mine structure, and that is what is limiting the asset in terms of productivity and results in high all-in sustaining costs. So on an annualized basis, we're currently producing at the narrow vein mining zone around 30,000 ounces at all-in sustaining cost of $2,300 to $2,400 per ounce. Importantly, we're going to transform Marmato by building the bulk mining zone at Marmato. And the bulk mining zone is targeting a different kind of mineralization. It's a porphyry-hosted mesothermal gold deposit. And that in turn allows us to do mechanized bulk mining by way of long-hole open stoping. And that is going to be very productive and low cost. So we expect the bulk mining zone, once it's fully ramped up in the first half of 2027, to produce 170 to 180,000 ounces at all-in sustaining cost of around $1,400 per ounce. So the Marmato complex, which is bulk mining zone plus narrow vein mining zone, is expected to produce more than 200,000 ounces once the bulk mining zone is fully up and running. We expect to deliver that project in the second half of next year and then ramp it up into early 2027. And then beyond that, we're focusing on unlocking the next level of growth. and that's Soto Norte and Toro Peru. At Soto Norte, 2 weeks ago, we've published a PFS that outlines what we believe is one of the best undeveloped gold projects in Latin America, and I will take you through a number of slides that show you why we make that statement. And then at Toro Peru, we will publish a PEA next month, and that will outline our vision for the first time as Aris mining management team, how this project should be designed, built, and operated. Similar to Segovia, where we as a management team for the first time articulated our view. So now, zeroing in on Segovia, as I said, we delivered the expansion of the processing plant on time and within budget at the end of June. And that allowed us to increase throughput capacity to 3,000 tons per day by debottlenecking the processing plant. And that gradual ramp up that we're now experiencing in the second half of this year is expected to allow us to produce 210 to 250,000 ounces of gold production this year. And then based on the expectation that by 2026 we will be continuously running at 3,000 tons per day, we should be producing 300,000 ounces of gold. Importantly, as we announced the other week, this ramp up process has been going very smoothly. So when you look at the chart on the bottom left-hand side, you see that in July and August, we materially increased the tons milled per month at about a rate of 2,400 tons per day, right? So that's about 26% higher than what we did in Q1 and Q2 respectively. And importantly, we delivered that increase without sacrificing grade. To the contrary, the process grade increased in those 2 months to greater than 10 grams per ton. And in addition to that, in August, we already ran the processing plant on a number of days at 3,000 tons per day, so demonstrating the design capacity. So when you think about this, this bodes very well for kind of like this year's outlook and what we believe this asset can achieve next year. And we are fortunate that we're able to deliver that type of production growth against this tremendously supportive, against the backdrop of this tremendously supportive gold price environment. And both of those things together is expected to result in meaningful cash flow inflection. So as I said, last year, the asset generated an all-in sustaining cost margin of $163 million. On an LTM basis, the all-in sustaining cost margin was $250 million. And based on the midpoint of our guidance range, which appears very achievable based on the numbers we have published for the year up until now, up until August, and taking the midpoint of the guidance range for our all-in sustaining cost, and using a gold price of $3,000 per ounce, which feels reasonably conservative at this point in time, the all-in sustaining cost is expected to be around $310 million for all of 2025. And clearly, cash flow should be even higher in 2026, considering that we're increasing gold production by another 70,000 ounces relative to the midpoint of this year's guidance. And clearly, as you know, mining assets tend to be fixed cost heavy, and Segovia is no exception. So by increasing gold production by another 70,000 ounces, we spread the fixed cost over more ounces, making every ounce more profitable. Now to Marmato. The construction is progressing well. It is on track. You can see here on the right-hand side a picture of how it looked a few weeks ago. So significant progress in terms of the access road, which is completed, the portal, which is completed. We're driving the decline from the portal. I'll give you an update on that in a second, and we're making meaningful progress in terms of the earthworks. You can see that the earthworks for the main substation have already been completed. The earthworks for the processing plant are nearing completion. And key equipment is being delivered on site, such as crushers, mills, tailings filters, sump pumps, you name it. We did have a small setback, as we announced when we reported Q2 earnings, and that was that the decline development had slowed. Reason being was we had material water ingress because of inclement weather. We fixed that by transitioning that work stream to our owner mining team instead of having our contractor continue to operate this. And our owner mining team is much better suited to operate in these conditions, and that had an immediate effect of increasing the advance rates again. So things are on track, and importantly, the decline development is not on the critical path for delivering first ore. Reason being, we already have a ramp access to the transition zone where development work is ongoing as we speak, and that will allow us to stockpile mill feed inventory underground and then get it out quickly once the decline has been completed. In terms of CapEx, as of March, $290 million left to spend. In Q2, we spent 24, meaning a delta of $266 million US still to go. Of that, we expect $60 to $70 million of spend in the second half of this year, and then the balance of around $200 million next year. If you compare that to our sources, $310 million cash on hand as of the end of the second quarter, and subsequent to the end of the quarter, the warrants that were outstanding expired, 99% got converted, resulted in an incremental cash inflow of $61 million. So very strong liquidity. On top of that, of course, significant cash generation from Segovia, as we discussed, this year and next year and beyond, but clearly from a funding perspective, it is this year and next year that matters. And then on top of that, we do have a stream in place with Wheaton. There are $82 million still to be funded by them. That is linked to construction milestones, 50 and 75% project completion. So in a tremendous funding position as it relates to our organic growth. Now to Soto Norte. As I said, we just published the pre-feasibility study 2 weeks ago. And what we've outlined is an exceptionally attractive project. The project has 4.6 million ounces in proven and probable reserves at a grade of 7 grams per ton, and 7 million ounces of measured and indicated resources at a grade of 5.6 grams per ton. Those numbers are on a 100% basis. We own 51% of it. Our joint venture partner is Mubadala, who owns the remaining 49%. The other thing that's, I think, important to highlight here is when you look at the bottom right-hand side of the slide, you see that in the first 10 years, we are mining above reserve grade. And that is really powerful when you think about time value of money from an NPV perspective, but also powerful in terms of payback period and project debt financeability of this project. So now let me share some numbers with you. The throughput of this project is 3,500 tons per day, of which 750 tons per day will be reserved for contract mining partners, meaning our owner mining rate is going to be 2,750 tons per day. The numbers that you see here are reflective of owner mining only, with the exception of CapEx, which is for the 3,500 ton per day plant. So at the owner mining rate of 2,750 tons per day, we expect to produce 203,000 ounces of gold annually over the first 21 years at all-in sustaining cost of $534 per ounce. And when you take into account initial construction capital of $625 million, a gold price of $2,600 per ounce, and a discount rate of 5%, that then yields an NPV after tax of $2.7 billion, an IRR of 35%, and a payback period of 2.3 years. If you assume a gold price of $3,200 per ounce, the NPV increases to $3.6 billion, the IRR increases to 42%. But what's important here is not just the numbers, they speak for themselves. It's a tremendous project from a return on invested capital perspective. But we went to great length to design a project that is also permittable and that can get community support. And so we've listened to our constituents very, very carefully as we've designed this project, and we found, I think, like a very good balance where we balance scale and returns with industry-leading social and environmental design features. So what do I mean by that? One, we bring the contract mining partners, our local community, in by reserving 750 tons per day of processing capacity for them. We will create significant local employment. We have an exceptionally well-calibrated community engagement model that makes sure we are very much in touch with our constituents and host community. Clearly, water has been a concern, so we went to great length to understand the different water systems and determined that the water that we would be dealing with in the mine is not associated at all with the more shallow waters in the Paramo. But importantly, we will be doing a lot of grouting to ensure that there is no contamination whatsoever. The other thing is that's important, we went to great length to design a project with exceptionally high recycling rates. We expect 96.5% of water reuse. And that's partially also driven by filtered tailings, right, that we're going to do. Filtered tailings, in addition to paste backfill plant, will also allow us to have a much tighter footprint than what was previously suggested. And importantly, given that we will be producing a gold-rich copper and pyrite concentrate, there's no cyanide or mercury involved whatsoever. So we think this is an exceptionally exciting project. On the basis of this PFS, we will do some further environmental impact assessment and file our environmental license application in Q1. And then lastly, Toro Peru, another significant project, 5.4 million ounces of measured and indicated resources at a grade of 1.5 grams per ton. Importantly, we're going to publish a PEA, as I said, in October. And this is going to be the first time that the Aris mining management team is outlining its vision for how this asset should be designed, built, and operated. And in the interest of time, I will not dwell too much on about this, but then conclude my remarks pretty quickly and maybe see whether you have a question or two. But stay tuned for Toro Peru, given that the PEA is forthcoming in next month. So when you think about investment considerations, we have the experienced leadership with a track record of value creation who has done it multiple times before. Our CEO, Neil Woodyer, has created and led Endeavour Mining and has created and led Leia Gold, and now this is the third stint of the team. We have extensive gold resources, clearly the lifeblood of any mining company, and not just extensive in terms of quantum, but also significant in terms of grades. We have a peer-leading organic growth production profile of 500,000 ounces to be delivered in the near term. We have the financial strength to deliver it, and we have a capital markets presence now that very much attracts interest of even the largest institutional asset managers, with a market cap of $2 billion and an average daily trading volume of $23.5 million for the 3 months of June, July, and August. And then lastly, that partnership model with contract mining partners is exceptionally important as it relates to us operating safely and productively and in lockstep with our local host communities. So when you think about all of this, there's a tremendous amount of re-rating potential. Today we have a market cap of $2 billion. Companies that tend to produce 500,000 ounces with a similar cost profile have market caps that are measured in multiple $billion. Another way you can look at it, free cash flow yields in 2027, when this company is going to be generating a lot of free cash, right? And so I think there's a tremendous opportunity as it relates to re-rating, and we are fortunate to have a lot of near-term catalysts to help deliver that re-rating. So we delivered the PFS for Soto Norte. We're going to deliver the PEA for Toro Peru next. You will see the sequential ramp up of Segovia over the next few quarters to get to 210 to 250,000 ounces, and then 300,000 ounces next year. And Marmato is a story of continued focus on delivering the construction project over the next few quarters until we deliver the project in the second half of next year. So I think we're exceptionally well positioned to deliver 500,000 of annual gold production in the near term and unlocking key growth projects that can then allow us to take the next step and potentially double again over the next few years. So with that, I conclude my remarks and see whether you might have any questions.
Yeah, unfortunately, I think we're at the time allotted for our full first session, so we'll have to thank Oliver, and you can grab him in the hall if you have a burning question. So thank you very much, Oliver.
Thank you very much.